Hello and welcome to Follow the Money. I am Su Jin Kim. Join us as we explore the tools and insights you need to jumpstart your financial journey. Philippine inflation eases sharply in April, dropping to its lowest level in over 4 years. The Philippine Statistics Authority reports consumer price growth slowed to 1.4% in April, down from 1.8% in March and 3.8% a year ago. The deceleration was driven by softer price increases in food and non-alcoholic beverages, including rice, vegetables, and fish. This below-target inflation print strengthens the case for further monetary easing and could impact BSP policy ahead of its next rate-setting meeting in June. Joining us today is a seasoned economist and market strategist with over 2 decades of experience in financial analysis. His insights have guided policymakers and investors alike through complex economic landscapes. Welcome to Follow the Money, Jonathan Ravelas.
Good afternoon.
Good afternoon, Jonathan. Jonathan, with headline inflation dropping to its lowest figure since pre-COVID, what is your read on this? Is this just a statistical base effect, or are we seeing a deeper structural cooling in prices?
Well, the last 3 prints of inflation was actually on the down trend. And so trend in terms of for inflation moving forward.
Jonathan, rice inflation dropped. Jonathan, rice inflation did drop a staggering negative 10.9% year on year. Would you say we're just now riding on good weather and imports?
Well, basically, this is a combination of factors. Aside from weather, the government strategy continues to do well for both monetary and fiscal policy. They've done a lot of things to be able to try to stabilize prices, particularly for rice. So that's why we've seen a major drop in rice prices. So this is actually very good moving forward.
Actually, rice prices are down, or global rice prices are at a 3-year low right now, and we have price ceilings or MSRPs for it. When we talk about pork or meat, pork inflation also eased to 7.7% from 8.2%. Do you think this means the government's maximum suggested retail price policies are successful, or is this more just a supply normalizing post-African swine flu and holiday demand?
Well, I think it's a combination of both. We're normalizing at the same time. This is actually trying to help keep prices at a low. And of course, other things that we need to consider is that oil prices since start of the year started to come down. So transport costs have been lower, and both of which have really helped bring the trend of inflation lower.
Yes, global oil and commodity prices are at multi-year lows. Jonathan, do you see this trend holding out to the second half of 2025? Or would global risks like Trump tariffs and Middle East tension reverse this softening, you think?
Well, basically, at this point in time, there are a lot of factors that have driven oil prices down. One is the fact that Donald Trump, the president of the United States, has been pushing for drill, meaning to continue to invest in oil. Now, the other thing is that Saudi Arabia and other OPEC Plus members have started to increase production. And of course, the third are the recessionary fears, so that demand isn't as strong. So it's keeping prices down. But you're right, there are geopolitical risks arising, whether it's coming from India or again in the Middle East, that could create a spike in oil prices.
And then with the peso strengthening since September 2024, is import-led disinflation doing the heavy lifting here? What is your threshold for peso stability to support rate cuts?
Oh, well, basically at this point in time, the stronger the peso is, this is a good opportunity to eventually cut policy rates. This year, I'm actually looking at just another 50 basis points or 75 if we were to look at it for the full year, down to 5%. But if June inflation is really closer to 1%, then definitely it could provide more opportunities of probably seeing inflation, doing more for monetary policy to bring it closer to 475.
I know BSP Governor Eli Remolona Jr. in the last meeting signaled further cooling. He said possibly 2 more rate cuts to total an additional 50 basis points. And you mentioned this is also likely, and markets are eyeing a possible cut this June. But with inflation at 1.4 and GDP missing targets, would you say there is really enough room to cut again in June?
Definitely. I think we can really do the 25, especially with the current trend of inflation and where the peso is currently at below the 56 level, is a good opportunity to probably cut rates without creating any risk for peso depreciation.
And do you agree with BSP Governor Eli's style or approach of doing it slow but steadily? And perhaps to make everything more interesting, if you were part of the board right now, how much would you cut rates in June for?
Oh, if I were part of the board, I'd probably do a 50. The faster I cut policy rates because I'm worried about the second half of the year. So trying to stem the potential secondary effects of inflation and currency volatility, now that the peso is slightly below 56, any aggressive cuts we could have a well cushion for its effects. So we could probably be back to around maybe closer to 57, 50 if we cut by 50. But that's actually already good because you can balance the spending coming from OFWs, and actually a slightly weaker peso could create some attractiveness, especially for tourism or eventually for those who are looking at the Philippines as a potential manufacturing point.
Could you explain further when you mentioned that a weakening peso would be a bit more attractive to OFWs and foreign investors? Could you expound on it more?
Okay, mainly because we're a country that's still building our infrastructure, and the challenges really for investors to come to the Philippines is that we lack a few of these infrastructures to eventually attract them. Aside from the very big consumer market in the Philippines, you have to understand 70% of our economy is consumption. So a slightly weaker peso could attract investors to come to the Philippines, especially the likes of people traveling to Korea or Japan because of the weaker currency that they have. So that also could create attraction to the Philippines.
And then since we're already talking about rate cuts, in your opinion, should the BSP preemptively cut ahead of the Fed?
Oh, well, eventually we've done that in April, no? While the Fed. That's why it was the opportunity with the weaker dollar had no consequences for any cuts. So I don't expect probably the Fed to cut in May. Most likely, probably in June or July, they'll probably do the cut.
And then going back to inflation, core inflation is stuck at 2.2%, suggesting services, rent, and non-food costs remain sticky. Would this weaken the argument for more aggressive policy easing?
Well, basically, the 1.4% inflation is actually at the lower end of the BSP's target for inflation at 1.3%. So I think there's still room probably in the coming months. But again, what it's just telling us that inflation is a bit sticky at core inflation because these are the non-volatile items. So that actually could probably still stay above 2%. But if we're talking about the headline inflation and what government has done, this is really still bringing inflation lower. That's why there's a lot of optimism of this rate cut, and this is also lifting the equity markets way past the 586,300 range that we've been trading. We're slowly trying to engage the 6,500 level.
And then if we see inflation below 2% until August due to base effects, what would this mean? Is it a good time to accelerate fiscal spending or election-related infrastructure projects?
Okay, I think one of the things that we should remember that we're a consumer-driven economy, and since 2022, investors were or consumers were really affected by inflation. So discretionary spending was a challenge. So you want to be able to thought that, meaning slowly as prices come down, people can shift their spending from food-related items to probably other things. So that is actually a good scenario for our economy. That's why aside from improvement in consumer counters in the stock market because of the lower prices, travel can again boom because people are slowly feeling less of the inflation pressure.
There we have it, guys. Mr. Jonathan Ravelas says travel will boom. So where will we go next? Now it's time for us to take a break. But before this, we can consider the Philippines' inflation rate has been on a downward trend, down 1.4% in April from 1.8% in March 2025. It is the lowest since 2019. What does this mean for our economy and your wallet? We will be right back. Welcome back to Follow the Money. We'll continue our discussion with Reyes Tacandong and Company Senior Advisor Jonathan Ravelas. Jonathan, to make things more exciting, could we get your full year forecast? What are you seeing in inflation and growth?
Well, as I said, I'm actually looking at I'm a bit more of an inflation hawk, so I'm looking at 2.8%. I fear the potential secondary effects of inflation and currency volatility that will come from the global uncertainty arising from Trump's tariff.
Global uncertainty is also something BSP Governor Elliot Malona Jr. has been flagging for the longest time. But going back to our country or domestically, do you think the government programs like the P20 per kilo rice initiative has had any real effect on food inflation yet?
Well, I think the subsidies that they've done and other tools that you mentioned are actually helping keeping prices stable enough. And of course, you have the monetary policy that BSP Governor Remolona kept rates unchanged till probably March and started when they saw that the potential trend of inflation is coming down. They started cutting policy rates. So all of this combined is actually creating a very stable environment for inflation. So, however, it's just that the potential effects after July 8th, when the 90th pause materializes, then definitely the damage that has already been done by the tariffs could create an inflation jerk. And that's what I'm worried about.
An inflation jerk. And with inflation near the floor, should the government shift its focus towards jobs, productivity, and investment confidence right now?
Well, basically, right now, our unemployment rate is around 3.8%. I think despite the fact that it's a low number, the underemployment rate is quite high. And at the same time, those that are trying to look for jobs, and sad to say that these are more of the college graduates, is the fact that there is a need to retool our those that have already graduated to the needs of the new economy, meaning they must be equipped with AI skills as well as data analytics to be able to address the needs of companies today in a more digital age.
We'll wait for the employment print tomorrow to be released by the Philippine Statistics Authority. But then we also have another question here about Trump 2.0 tariffs. We would like to know, how would the Trump 2.0 tariff regime affect the Philippine inflation, especially with 145% tariffs on China and 10% blanket tariffs on the rest?
Okay, let's put it this way. The tariffs that have been slapped on the Philippines have no real effect to us because we're purely a domestic-driven economy. We're a consumption-driven economy. However, the potential secondary effects of the food and other items that we import could eventually affect us. And this is what I fear in the second half, especially if some companies today have already asked for prices for delivery for the second half. And they will not wait for July 8th. They'll probably ask for the prices now. So definitely there could be some price adjustments. So that is an unknown at the moment. So I feel that in the second half of the year, inflation will slowly pick up to 2.8%.
You mentioned jitters over the second half of the year. Are you worried about global oil and freight costs rebounding in the second half of 2025 as a result of the rising trade tensions?
Oh, well, basically, I'm not as worried. It's just that depending if there are more geopolitical issues arising from the Middle East that could affect oil, or other nations that will eventually have some uncertainty, whether it's driven by geopolitical or other issues coming, or eventually the impact of trade. So, of course, right now there are a lot of expectations of a 40 to 60% recession in the U.S. So this is also something that one good reason about the Philippines is that we are doing a lot of infrastructure spending. Hopefully, this will sort of offset any potential slowdown that this potential recessionary fears would have an effect on us.
While you're here, Jonathan, we'd like to pick your brain. Do you foresee a scenario where the BSP would be forced to pause or maybe even hike due to imported inflation risks?
No, I think at the moment for the rest of the year, it's really more of accommodative. I think one of the things that I don't hear on media is the fact that the BSP was able to do a lot of managing the currency volatility very well, especially in the early part of the first quarter. So that actually also helped try to bring down or stabilize inflation, although the transmission of a 1 peso appreciation or depreciation is around 0.04, very negligible, but it gives confidence when you have a very stable currency.
And then, just to explain, would you describe the current disinflation as broad-based, or is it still dependent on food and oil prices?
Well, basically, the main drivers, because the biggest component in our inflation is food, the volatile food, and then the energy prices. So these are the two major components that greatly affect our inflation. But so far, again, it seems that the stars are aligning mainly because you have, number one, with the help of all of the tools that the government has done, inflation has come down to one of the lowest since 2019. And of course, it was also helped by the lower oil price and, of course, the appreciating currency. So these are actually good signs that hopefully the economy can sustain. And especially we're waiting for the first quarter GDP numbers, where hopefully the combination of slowing inflation, lower oil price, and government spending should at least print 6% for the first quarter. So this is what I'm expecting. Of course, needless to say that there are also tailwinds from the midterm elections that should provide a lift to the economy.
Jonathan, since you mentioned that the stars are aligning, what's your one piece of advice for our viewers when it comes to navigating a low inflation economy?
Well, basically, despite the fact that inflation is slowing down, there are other things that, the stock market is relatively cheap. Investors should continue to take advantage of the low prices to eventually incur a yield between 6.5% to around 7.5%. So you can do that by buying dividends, stocks that give good dividends, or you can buy long-term government securities, which will probably give you that same rate, and that's roughly closer to the 10-year rate.
I know you already mentioned your inflation and growth outlook, but just to have a quick overview, given that the inflation further fell to 1.4% in April, what would be your GDP outlook for Q1 and unemployment rate projection for March 2025?
Well, basically, I'm looking at the GDP for the first quarter to hopefully print at 6%, which is also my full-year target this year.
And that is all the time we have today. Thank you so much, Jonathan Ravelas, Senior Advisor at Reyes Takandong and Company.
Thank you, Su Jin, for having me. Thank you again.
Before we go, here is a POV from Nobel laureate economist Milton Friedman. Inflation is taxation without legislation. And that's it for today's edition of Follow the Money. I am Su Jin Kim. Thanks for watching. Keep it here on BNC, the Bilyonaryo News Channel. Always on top.